My next speaker is really just going to give us an international perspective on what sort of retirement funds excel. So what is the international perspective in terms of the distinguishing features of excelling retirement funds? And then he's going to touch base on something that is very topical amongst a lot of us who are on pension funds, and that is the whole issue around passive versus active investments. You know, are we paying active managers, whereas we should be in passive investments and we don't have to pay fees? And the statistics right now are quite interesting in the sense that the statistics that I'm hearing is that only about 20 to 30% of managers actually are able to beat that benchmark net of fees. So are we overpaying? Should we go passive? I'm looking, and I would like to welcome Mr. Mike Brown, the Managing Director of ETF SA, which is the home of exchange-traded funds, to give us his perspective. It's a debate that I think all of us would want to hear about. Please help me welcome Mike Brown.
Thank you. Right, so good morning, ladies and gentlemen. It's a pleasure to be here, and I'd like to thank Nkonki for organising, I think, a great agenda for the day, and in a subject which I think is a great subject, retirement funds and pension fund reform, and the issues that I think are all become a global problem, a global issue. I'm a financial services provider, a FSP, so I'm coming from the side of the advisory side and product provision, and I've specifically been asked to talk about the international elements of what's happening in retirement fund reform, and which is an interesting subject for me to dabble in. So I'm giving you my contributions there, and also, as introducer said, as I do come from a company called Exchange Traded Funds South Africa, we are experts, or we're specialists in using passive investment products. So I want to close on the passive side of investments. But so there is a bit of an agenda, and it's up there. And I always put an agenda up because it sort of more or less, keeps me in control of what I'm saying. So you'll see where I'm going, hopefully, on this. But I want to be very brief on the first element, which is current trends in global retirement systems, and spend a lot more time on principles for excellence in retirement funds. And I've come up with a list of 10, and we'll talk about that a bit later. But your auditors, you're used to ticking your boxes, so there's 10 principles, and we can try and keep to some sort of structure as we go through those. And as I say, in the end, I'll round up with a little bit of a chat on the what's happening from the passive point of view. So from current trends in global retirement systems, I really just want to focus on two issues, and there's a lot of issues, as we know. And it's really this longevity issue. The demographics have changed the industry and are changing the industry drastically. People currently, in the current generations, are living 20, 30 years in retirement, and most of the people in the room, particularly the ladies who are pretty young, are going to live probably 40 years in retirement. It's a completely changing industry that you're probably going to spend more time in retirement than you often do in employment. And how do you manage that longevity in terms of keeping capital going or investments going in order to make sure that people's money lasts as long as they do in retirement? So that longevity issue is, I think, probably the greatest issue facing the industry today. And what's coming up in the immediate term, and of course a lot of these are long-term issues, is the fact that the equities market seems to be the only asset class at the moment that's giving the sort of returns and growth in capital that can keep your money going for that length of time. So certainly, as many of you know, if you read any of the research coming out of America, they're talking about when people go into retirement at 60, 70 years of age, you put 65, 70% of their portfolio into equities. Now, only a few years ago, that would be unthought of. 60, 70% of your portfolio would go into government bonds or cash. But government bonds or cash aren't going to give you a big enough return to grow capital for the next 20, 30, 40 years. So a complete change in the structure of portfolios. And therefore a global search taking place for equities. because you can't just stick to American shares or South African equities. You have to look across the world at excellence in companies globally that will give you the sort of returns in a globalized environment where corporations are becoming multinational, in order to look at the sort of portfolios that can structure the ability to finance long retirements. And so I'll touch that on that in my talk. The other thing with longevity is that people are working a lot longer. So we've got to design retirement and pension systems that can accommodate. We can't just say you're going to retire at 55 or 60 and that's it, because those people are going to continue to work for some time. So can they draw down part of their pension and continue to earn a salary and contribute to a retirement fund? And what happens when they do actually retire? You can buy assets. You can buy a motor car when you retire, but after 10 years that motor car is finished. So you've now got to access capital. So you can't just have an annuity scheme that just provides income. You've got to have an annuity scheme that can also provide drawdowns on capital from time to time. So the whole longevity issue is a critical issue, and this will come up in some of the discussion I do later. And secondly, as my introducer kindly said, the swing towards passive investment. And passive investment is really where you're just buying an index. So you're buying and an index measures the average return of a market. So if you've got the top 40 index in South Africa, that's really the average return of the JSE. 90% of all the trade in the Johannesburg Stock Exchange takes place in the top 40 companies. So if you buy that top 40 index, you're buying the average return of the market. And you can buy average returns of any market across the world, equity markets, bonds, listed property shares, whatever have you, inflation linkers. So putting together a series of index tracking products in order to provide you with portfolios that can do what active managers, people who try and outperform the market, have been doing for many decades, is becoming a significantly large industry worldwide, just starting in South Africa. That's why it's quite interesting. But 68%, I think the number there, I haven't got my glasses on, and even I've got my glasses on, I'm looking at a screen in front of me, which is just the wrong sort of range, of new money in America in the last year has been going into passive investments, index tracking investments, rather than into active investments. So big changes taking place globally in industries. And passive investment is just not buying a straight index. It's buying smart indices, what they call smart beta, where you look at a specific style. Can I buy an index which picks companies based on value propositions, on fundamental propositions, on perhaps momentum, which are the shares that are running at the moment? Can I pick a certain style? Can I buy an index of companies that just pay very high dividends or have very low volatility, low standard deviations? So I can build a portfolio using index trackers to give me the sort of solutions that are required in order to meet the demands of funding people's retirements 20, 30, 40 years down the road. So those are the two issues that I want to just highlight. And then let's get into this excellence in global retirement funds, which is what I've been asked to talk about. Interestingly enough, fairly recently in March this year, the CFA, the Chartered Financial Analysts, came up with a global report. I think this is something that they'd been working on for some years with Mercer. And this is an interesting thing or interesting report in which to use as a basis for our comments, because this is not a government or a vested interest, a retirement company doing research. This is a bunch of CFAs, well-educated people taking a dispassionate view on the industry. And so I'm using a lot of the stuff that they came out with this report, which came out in March, so it's quite recent, but also throwing some modifications in on my own basis, I think, to try and pull this back to South Africa, because this is a report which looks at the global industry. So with this list of sort of 10 odds, and some of these 10 are my sort of views rather than the CFA views, but this is something that we can perhaps work around. And the first issue really is that what sort of structure do you use in the pension fund or retirement fund industry? And most people are coming up with pillars. The CFA says we have 4 pillars. The South African Treasury Report and Retirement Fund Reform some years back, one of their reports also had this pillar approach. And the first pillar is an old age pension type structure, which is financed through the taxation system and which really just meets basic requirements of people who reach retirement age who don't have access to other forms of retirement. And that typically comes, as I say, out of the fiscus. But Pillar 2 is where I think a lot of work is taking place globally and a lot of developments are happening. And that's that you have a pension fund system or retirement fund system with mandatory compulsory contributions. And that has to go right across the board. Even people who are self-employed or who are part-time employed, labor brokers and people like that who are creating temporary employment, belong to a mandatory type system where there's a minimum contribution. And this can be managed by government or by the private sector or a combination of both. But it's really in this mandatory area that I think we're seeing significant developments. And without that contribution, it doesn't look as though this whole retirement problem can be fundable. The third pillar is a pillar which I think has been around in many countries, including South Africa, which is where you have a voluntary type of contribution taking place into retirement funds and umbrella funds and things like that. And there governments do provide some support through the taxation system. And then finally you've had the voluntary where people can save outside of the formal structures for their retirement. So that pillar system is really coming in globally. And South Africa has got, or really is in place and putting in place that type of structure. Now, in terms of those 10 principles, the second one is this idea of the mandatory contributions, the minimum level of contribution that takes place into the retirement fund system right across the board. Everybody contributes to that who's employed. So you are creating this pool of savings in society. And the research that's come out of CFA and others says that normally this has probably got to be something in the level of 8 to 10% of income goes into this mandatory type of saving schemes or retirement schemes. In countries like South Africa, where we have a very skewed employment or labor markets, where a limited number of people are really formally employed, and a lot of people not having access to formal employment, or where we have a big difference between high and low income earners, that contribution rate might have to be somewhat higher, 15% or so. But we do need, and this is where we have to do further work in South Africa, is moving towards this mandatory system and scheme and getting everybody to buy into it, labor, business, government, and others. And how do we structure this? You know, we were talking about a national pension system, you know, perhaps going through the post office or whatever have you. We need to do a lot more work on how this is going to be structured and where these mandatory contributions are going to take place. And of course, for your profession, checking that these contributions are taking place in an efficient way by the companies or the organizations, enterprises that you audit, I think will become quite an important principle. So this is a move towards compulsion. And that's a very difficult term for some governments to live with, to go to certain sectors of society and say you will contribute to these types of schemes. Now, the third principle is that if you're going to create this structured retirement system, the taxation structure is a critical part of the contributions, that both the contributions towards retirement funds should be tax deductible up to a certain limit, and South Africa has done this. And as far as I can see from the more recent publications that have come out, it looks as though we will introduce the higher thresholds in terms of taxation contributions that are tax deductible from next year should come up to 27.5% of taxable incomes, which is generous. But a lot of countries, and South Africa included, also allow all the growth in a retirement fund to also not be taxable. So income, dividends, capital growth, all of that is also not taxable. And so the fiscus, of course, as ourselves, as taxpayers, is making a big contribution towards this retirement system. But we have to do that in order to create the incentive. As the Minister said earlier, South Africa doesn't have a culture of savings. So we really have to sell these investments on the basis that you're getting something. Your tax rate's going down. Everybody likes the tax rate to go down. I mean, auditors know that. That's part of your job, is to make sure that the taxation is being paid where it needs to be paid. But you also have to compensate people for the fact that they're putting money away that they can't access for a long period of time until they reach retirement age. So the taxation system is undergoing a lot of work and a lot of stress globally. And I think South Africa's quite well along the lines of coming up with the sort of excellence that I think we're more or less in line with what's happening from a global point of view. Now, the next principle, the fourth one, and this is, of course, also a bit of a tough issue, is that your contributions need to be immediately vested and shouldn't really be, as there's a quote there from the CFA report saying that the minute you start getting leakage, that when people change jobs from one job to another, they can access their retirement savings. The lack of preservation is a massive, massive issue in terms of sustainability of growth in retirement savings. So you really have to try and create a system where people, any contributions you make, stay in the system. You can't draw those out other than under certain circumstances like immigrating or disability or death. And so you're now getting into this whole area of preservation, and that's another political minefield. Because in South Africa and other countries, we've got used to the fact that when we change our job, we can access our retirement savings and go and buy another motor car or go on a great holiday to Mauritius. And there is a big, big need for that money to stay in the system. Just to give you some ideas, when we talk to our sort of retail client base, and ETFSA really has just a retail client base, but we often say to people, and a lot of the people that we talk to are in the sort of 30 to 40-year age bracket. And we say, well, you've been in your first job for, say, 10 years. And the contributions you got out of your retirement fund are only about, say, 200,000 Rand, which is the contributions you made and the contributions the company's made. And you take that 200,000 Rand out, and that's great because you pay off the bond or use the money in some form or other. But if you keep it there, in that retirement fund, and this is the ETFSA Wealth Enhancer Fund, which is a CPI inflation plus 7% fund, and it gets inflation plus 7%. What's that money worth in 10, 20, 30 years' time? And the figure there, I think, is 28 million Rand. And that's a big, big number. And that's just preservation. That's just that money's sitting there and it's compounding. And so if you can get people to keep that cash in the system, then, of course, your retirement schemes become much easier funded going down the road. But preservation's hard to sell to unions and to some employers and to people themselves, or to create a system that takes those funds and puts them into either into preservation funds, but more particularly into retirement annuity funds where you can continue to make contributions until you reach retirement age. So you can get the tax deductions plus also the growth in preservation. So preservation's a big issue. And the other issue in preservation, and I don't want to go backwards just in case I push the wrong note, but it's portability. That when you leave one area of employment, you can transfer your retirement savings across and do that effectively and efficiently. And the Act allows you to do that in South Africa, Section 14 of the Act. But it's amazing how, and you can see it in my particular business where we get a couple of people every day come in and say, I want to transfer my RA. You now have penalties. You now have all sorts of issues where the old retirement fund tries to hold on to that capital that they've got. And you can't have portability if you allow penalties. You've got to be able to transport 100% or very close to 100% of those savings across to another retirement provider, either another occupational pension fund at the place they're going to get employed at, or another retirement fund. And so South Africa has to move in that direction of having portability, Section 14, much more streamlined, that people's full capital can be preserved. That's a big issue. Right, so the next principle is just this, and this is a global issue as well, having a default option. People don't really understand retirement. They don't have time to worry about it. I'm now at my company, they say you can pick 5 or 6 different options. Most people don't know which one to pick. So having the right default option in place and making sure that the legislation and regulations protect that default option so that's just not a bad product, it's probably the best option you can find. And default is becoming a big issue, both before retirement and after retirement. Now, coincidentally, as I think many of you know, I think it was only last week, draft regulations came out from the Treasury about changes to the Act that will really regulate default products much more rigorously in South Africa. And that's a great document. Of course, it'll sit in the industry for another year or two because the pension funds and insurance companies and all the rest will debate and it'll go back and forward and so on. But South Africa is moving very strongly towards the default type options and saying the right sort of things. Preservation, making people who move out of companies have to become paid-up members of a default system. So now we're getting compulsion, portability, transferability. If you read that legislation, the draft regulations, and you read the explanatory document, the Treasury must mention at least half a dozen times in there, we really think this should be a low-cost, passive product, should be the default options. So there's a lot of work still to be done on that. But it's really interesting that South Africa's come up, or that the Treasury has come up very recently with a great document on default options. And that's something that we as professionals in the business and auditors and others will need to get our hands around. Then costs. Non-disclosure of costs, massive problem worldwide. I quote there reports that came out fairly recently, I think only in the last year, John Bogle and the Financial Analyst Review in America, saying that American pension funds don't disclose at least 2% of the costs that they have. And that's a global thing. South Africa, it's probably slightly higher than that. And costs matter, particularly over time. So moving towards a basis of full disclosure of cost, transparency, and being open about what the impact of costs is, I think, a big issue. And in South Africa's case, the Treasury and their various reports, particularly the most recent report that they came out with in 2013, I think, in costs and retirement funds, highlighted this particular issue. Here again, just using that earlier example I had where we were talking about a 200,000 Rand money coming out of a provident fund, somebody around about 30, and they're now investing. The top column is a low-cost passive fund. The one at the bottom is where the costs are about 2.5% per annum higher than that. And that's typically what a unit trust-based RA fund costs you, is 2.5% higher than a passive fund. And the Treasury came up with the same numbers, by the way, in their report. And look at the difference. Just what costs. 2.5% higher costs means that the capital that's available when this person reaches retirement is massively different. Massively different. John Bogle identified in America that if you're in a low-cost fund, the amount of capital you have after 40 years, and there are a lot of people who will be saving for 40 years. They're in their 20s, they're only going to retire 65, 70. The low costs option means there's 65% more capital. And I did the numbers in South Africa, and it's the same figure. It's 65%. And funny enough, the Treasury did this in their cost report that came out in 2013. They also came up with that same figure. If you're in a low-cost retirement fund option, your benefits in terms of capital accumulation are substantial. Just that one factor, just costs. You don't have to have anything else. Just get a low-cost product that meets its mandate, CPI plus 5, CPI plus 7, or whatever have you. So that's another big issue. Do costs matter? Well, they certainly do. All right, so now we're moving along a bit more. We're on number 7 now. Flexibility. People are going to carry on working after they nominally retired. So we have to create a system where people can contribute, either perhaps drawing down some of their retirement fund, but keeping some of it intact, but also adding additional income to that and maybe making contributions out of that income and getting tax concessions for making those contributions after they've retired. In the United Kingdom and the United States, we've got full employment economies. 5% unemployment in America, and in the UK, I think it's lower. First time since the 60s, full employment. A big part of that full employment is that a third of the new jobs being created in America are people who've reached or would have reached retirement age. And that's a big, big issue. And they're contributing towards employment.
So if you can watch your time.
Okay. How much time do I have?
You're almost actually out of time.
Okay, all right. So, and the other issue that one has to look at is this issue of, if I now do reach retirement, can I access my capital in retirement? I can't just get an income fund that pays me income. I've also got to be able to access retirement, capital in retirement. So flexibility. So now number 8, the benefits don't only have to be income. So we can't put people into a guaranteed fund that just gives them income benefit. We have to be in a position to give them access to capital as well as income. And that means some quite big modifications, because our living annuity structures and all the rest don't always give access to capital. Or we've got to look at how we create structures that do that. In terms of regulations, I think I've gone one too far. Have we got 2 things? One, in terms of regulation controls, the global excellence indicates that we don't think either governments or businesses should control retirement funds. The global excellence says that these things should be independently controlled. And that now brings into focus the role of the trustee, because you now have a board of trustees or board of management that has to control that fund. And that's a very important element for the audit committee, to make sure that those board of trustees are meeting their requirements in terms of compliance, in terms of corporate governance, and all the other issues. So the regulatory issues increasingly are moving towards the role of trustees, and there's been quite a lot of stuff in South Africa and globally on how do you train trustees? Do you have professional trustees? Do you have amateur-type trustees? Do members get the ability to select trustees, or should you have independent selected trustees with the right sort of qualifications? And then what sort of regulatory framework do you build around this particular structure? So that's the 10 principles. I won't have time to go into the passive investments case, but my paper will be available. But I think those areas of excellence indicate that South Africa is quite well along the road. I think our Treasury and our regulators, FSB, and now we've got the Twin Peaks regulation coming in, I think are putting in place the right sort of structures for us to develop a strong retirement fund industry in South Africa and globally. And I say that, and this is my last comment, with some element of emphasis, because the retirement fund industry over the next 20, 30 years will become one of the world's biggest industries, because it's going to employ more people that it's paying out annuities to than virtually any other industry or any other sector of industry in the economy. So we're talking about a massive, massive industry, as more and more people will be drawing money out of retirement funds than they will probably out of full-time employment, because the demographics are going that way. So it's critical for global governments, local governments, but also global industry and others, and people like yourselves who facilitate the smooth functioning of retirement funds, I think, to get on top of some of those issues. Let me leave it at that. It's a great pleasure to have spoken to an audience which I think is going to play a big role in the development of retirement funds in South Africa going ahead. And I'd like to leave you with just one final comment, and let me just page through this. And this is just a slide showing Warren Buffett, who's basically regarded as the world's key investment expert, or one of the key investment experts. He's the old bloke on the left. The lady on the right is his wife. She's doing all right because she's married to one of the world's richest men, and he's doing okay. She's about half his age, so that's great for both of them. Now, Warren Buffett spent his whole life basically showing that you can outperform the market. You can select good companies or select portfolios which will give you excess or alpha returns. Now he's saying, when I'm gone, and he's quite an old bloke, so he's going to snuff it sooner or later. what you must do with my money when it's left, and that's a couple of $100 billion, so there's a fair amount of money there. Put 10% into US government bonds. Put the other 90% into an index tracker. So here you've got the world's best known, most respected asset manager saying, asset allocation, well, put a bit of money into bonds, but most of this money is going to have to sit in an equity index tracking product. Let me leave you with that thought. Thanks very much.
Thank you very much, Mike. Can I invite you for a few minutes to sit for questions? And just to remind everyone that you can actually write your questions on the little tools that you have in front of you, and they will come through to this iPad that I have. However, we will take questions. We will also be allowed to evaluate each speaker after they've spoken. I have the first question for you, Mike, from somebody in the audience, and the question is, most people resign in order to tap into their retirement savings. How are other countries dealing with that leakage through law?
It's basically preservation. You say that you can't access those savings that are part of your pension fund. So, and a lot of countries do have that regulation. But what it does, it creates some challenges for business, because businesses, when people are leaving the company or they're retrenching people, and we're seeing that a lot at the moment in the mining industry, what you've got to do is you've got to come up with a retrenchment package, and Labour's got to make sure this happens, where part of the retrenchment package, the employers can take that capital, because they need to live for the next few years or next few months while they look for another job, or they go through retraining. But another part of that capital has to be preserved, because you do need to look after those people that are leaving the mining industry or whatever other industry in their retirement age. So part of the regulation is to say, well, what money when I leave a company is accessible, and what part of that money should perhaps be used for retraining, and what part of that money should not be accessible. And we've still got to make some changes to that in South Africa. But globally, there is quite a bit of preservation legislation that's in place.
Okay. Do you think, I mean, just if we focus on that question a little bit, so there's been a bit of resistance, as you've said in your speech, from the unions in terms of going towards preservation. And I would imagine part of it is we don't necessarily have a fully fledged national security system. So the very concept that you're talking about, that when people leave in the short term, there's nothing to eat in the house. Why would they be thinking about preservation when there are short-term issues that they need to look at? Very much so. I mean, I don't want to blame the unions here. No. Because I think unions have been quite consistent, but I think companies have got to say we need to have, when we're retrenching people, we need to put in place some sort of system which will, perhaps instead of giving them a capital outlay, we'll continue paying them a salary for the next 6 months while that happens. But the capital that's sitting in that pension fund, we'll try and preserve that capital, that they don't go and immediately spend that. So I think it's something that has to be worked out between the unions and business and government, I think, facilitating it, because if South Africa was an economy that was creating 5% real growth and there was plenty of employment around, we wouldn't have these issues. But we do have these issues. And so I'm sensitive about the issues you raise. But I think we can still structure something. But it's not just a union problem, it's a business problem as well. The business community has to come to the party. I like what you're saying, that it's not just the employees' problem, it's also a business problem. And I think there's agreement that there's a need for preservation, but we need to take care of the immediate. And I like what you're talking about. So the next question is, why does SARS tax at an acceptably high levels when a pension is cashed before retirement? I thought that was obvious, but I want to hear what you have to say. Well, that's part of the preservation. If I want to draw out my retirement funds, I've got to pay quite a high tax rate on that. So I think that's part of the preservation. So element. The incentive to preserve. The incentive to preserve. Yeah. I think that's part of it. Post-retirement, I think, yes, we could perhaps be a little bit more generous there, but don't forget the governments or the fiscus, and that's all of us, because we're all taxpayers, hopefully. And our auditors are here to make sure we do pay tax. But once you go post-retirement, only your first 500,000 is tax-free, and after that it gets taxed at quite
quite a strong sliding scale. Perhaps there could be more concessions there. But don't forget, government's been giving away tax incentives to retirement fund savees for a long period of time. It has to start drawing income. And it'll draw income once people start drawing retirement proceeds, and then you tax at an income tax rate. So I think there's some scope for the tax system to perhaps be more flexible in this. But the concept of when I get to retirement, and I've had all these tax concessions, so I've had virtually tax-free contributions and tax-free growth in retirement, I have to then pay tax. I think most governments would buy that concept. Sooner or later, you're paying tax. We're giving you concessions now, but you're going to pay tax at a later stage.
Okay. The next question, I think, I'm not going to post the question, but it's a comment, really. It's government allow people to take that pensions when they move from one job to the other. But you would say, you'd agree with me, that's one of the things that government is trying to bring to a stop through preservation, is that a lot of the DC funds, provident funds, would have the same regulations as the pension funds. So I'm going to move on from that. Yeah. The key question, I think, is around passive versus active investments. And it is really around, given the proportion of the JSE owned by pension funds, who remains to be the market through active if pension funds go passive?
Yes, I think, basically, even in America, where you've got a big shift towards passive investment, the big portion of your American stock market is still owned by companies themselves, long-term savers, insurance companies, and all the rest. The role played by the passive investor is quite small in terms of the total ownership of the stock market. And in any event, there's day-to-day trading. So I think we're a long way away from the point where people who just go and buy the index are going to influence the size or the price of shares on the stock market. So I don't think that's an issue. What does happen, though, and this is becoming an increasing problem for managers, is that if a share is in the index, whether it's in the S&P 500 or the FTSE 100 or the JSE Top 40, those shares tend to trade at much higher multiples than companies that are not in the index. And that's because there's just a big demand. You can see global money moving in and out of South Africa, and it just buys 10 shares. It doesn't go and buy the 400 shares in the JSE, it just buys the top 10. And you can buy that top 10 in an index. You buy the industrial index, those top 10 shares are about 70% of the index. So you're really just buying those companies in the index. And so those are the shares that really determine the value of a market. And so there are some valuation issues that come into what passive investments do to markets. And so you find a lot of active managers say, well, I won't buy these shares because I overvalue. The PE is too high. That PE is going to stay high. Those PEs are going to go a lot higher over time as people just go in and say, I'm happy to buy South Africa, but I'm not going to buy I'm not going to buy a South African bank. I can buy a bank anywhere in the world. But I might buy MTN because that's a company that looks interesting to me because they've got a global footprint. It's not a South African company. They earn 90% of their money outside of South Africa. So they will come in and buy certain companies, and those companies will have very high valuations. And therefore, the index will have fairly high valuations. So the passive manager has to look at that and say, well, I'll offset those high PE companies by buying an index with low PEs. And that's where smart beta comes in. So I'll buy a low vol Trax or low PE index to offset. So I'll offset the high concentration levels by buying a market cap index, by having a smart beta product that offsets those high concentration levels or reduces my overall standard deviation in my portfolio, or looks at my risk return. So your passive manager plays a similar role in many ways to your active manager because they go and put a portfolio together, but they just use passive products as the building blocks. And that passive product, putting together passive products as a building block, various people are calling it different things. They're calling it systemic beta or beta A or synthetic alpha. But you're basically using active management techniques, but you're just using index trackers to give you the same performance and very often much better performance than the active manager did. And you can throw in bonds and property and alternative assets into that mix. So the passive industry is becoming as sophisticated as the active industry, but it's doing it at a massive lower cost. And it's doing it at a much lower risk. And that's what the retirement industry needs.
Okay. So the takeaway message from your presentation is we should be considering passive. that we don't have full exposure to just market risk, as our assumption is that there's no intervention, there's no active intervention. So that's what smart beta is. But there's definitely that we should consider passive as an investment. I
think it's one of the alternatives that should be looked at by asset managers, and I'm sure that, in the audit profession here we're not talking to an audience of specific asset managers, but it's something that one needs to look at. But certainly the default option, and it's going to become regulatory that there has to be a default option, has to be offered both pre and post retirement. The passive industry will provide, I think, the products in that default option.
Okay, Mike. We could be talking forever, but we have run out of time. Thank you so much for your presentation.
Appreciate it. Thank you very much.
Thank you.